Good afternoon, everyone. I'm Kevin Testo. I'm a principal with the Bonadio group. Today, John and I are going to be talking about best practices for both school trustees, audit committees, as well as for management, because we understand that some management may be on the conference as well. I'm going to start sharing the slides here. Just want to be sure. There we go. Let's just start here. Slideshow. There we go. The goal for today is I'm going to talk briefly about what it means for establishing a good framework for your school, what it means to have a good board, what it means to have a good management at your school. Then John's going to talk a little bit about fraud risks that audit and finance committees should be considering over the next year or so when you're reviewing financial statements. John's also a CFE and can bring a lot of interesting information to this presentation in terms of fraud. We will give you an update on NYPRA, which is the New York State or Nonprofit Revitalization Act. This training is really not meant to be a complete training on NYPRA, but rather an update of what happened in December of 2015. And finally, I'll come back and conclude on the Audit and Finance Committee considerations regarding what the committee should be doing when they interact with auditors such as ourselves. So as George mentioned, the slides will be available at the end of our presentation. I'll go over some of the slides fairly briefly because there's a lot to take in here. And at the end of each of the four sections, we'll pause for any questions so we can answer any questions you may have on that specific topic. So that being said, before we even talk about internal controls or considerations, we have to step back and look at what is the framework for establishing the right committee, the right board, and the right team for your school. Well, you obviously need an executive with a passion for the mission of your school, someone to take care of the finances, day-to-day operations, as well as an active and involved board with at least one member of a financial background, and we'll talk about that. So let's talk first about what your executive needs. Well, the executive needs to have a passion and understanding of what risks are involved with the organization, both from a financial, political, economical standpoint. The executive, or the head of school, I should be saying, needs the ability to motivate the board. They have to have a good relationship with the board, but the board does not want to control the executive, and the executive shouldn't be controlling the board. There has to be nice boundaries between the two. But more importantly, the executive needs to communicate any board issues, such as finance, cash flow issues. Is there any enrollment issues? That all has to be communicated to the board. Strong management team also is needed by the executive. The executive needs to have educational employees, HR employee relations, fundraising, development, and a strong financial accounting team as well. That's a lot to ask, but that executive needs to rely on all of those teams throughout the year to be effective. Another area that needs to be effective, IT. That's continuing to be a more strong area that needs to be examined each year. There needs to be strong IT controls, IT systems, security, backup. Those are all things that have to be considered that makes the executive their job a lot more efficient and a lot more effective. The financial management team is responsible for timely and accurate financial reporting, budgeting, forecasting, and strong internal controls. And we'll talk about a lot of internal controls in the next few slides. So finally, the executive also needs a strong board. What does it mean to be a strong board? We really see it for having three bullets here. You need to be diverse. You have to have a certain size and establish meetings and certain committees that meet throughout the year. So let's examine each one of these three bullets. From a diversity side, the best way for success is to have a high quality board members from all different walks of life. To have a board member from financial, legal, development are just several examples of who should be on a board. As you all know, a school can have needs for all these different areas, and to have a board member involved with each of these makes life a lot easier when making management decisions. Now, what's key here is independence. You may have heard a lot about independence of board members required by NYPRA. Well, board members should not be employees, according to NYPRA, and they should not have substantial financial interests associated with that school. We'll talk a little bit about the audit committees, but those audit committee members need to be independent as well, and we'll move on to the next slide. But those are all important areas to think about when bringing board members onto your new board. Now, studies have shown a direct relationship between the board size and the effectiveness of it. A minimum of 12 members is usually needed, but no more than 18 members. Term limits are equally important. We've seen that without term limits, individuals start to becoming more controlling in the way they operate under board and other committees. So we recommend usually 2 to 3 years term limits that could be voted on at the end of that term limit length. We also see minimum committees should be included, including an executive committee, finance and audit committee, strategic planning, or just to name a few. Now, often the question comes up, do you need both a finance and an audit committee? Well, with NYPRA, it's important to remember that 3 independent board members need to be on an audit committee. So the answer is you don't necessarily need both, as long as you can make that requirement met by having 3 independent board members on your audit committee. And those committees will oversee the financial reporting process, have the interaction with the auditors, which we'll talk about in the 4th section. We recommend board meetings are held 6 to 10 times per year. Materials should be distributed in advance to give the board members a chance to look at those materials, so you're not wasting a lot of time at the meetings reading reports. You're only concentrating on those main issues that need to be voted upon. The board resolution should be documented in your minutes both clearly and concisely, so that someone can go back and look to ensure that those answers have really been voted upon and determined to be accurate. And we also encourage a lot of discussions and questions at boards, especially when we're dealing with auditors. But we recommend limiting those debates to isolated incidents to keep that meeting time within 1 to 2 minutes.
2 hours.
2 hours, excuse me. Often the question comes up on could a full board have an executive committee make decisions? And the answer is yes. If a lot of decisions have to be made throughout the year, we recommend having an executive committee make those decisions. It's much better than having one person with a strong personality making those decisions. We just encourage everyone to look and understand the bylaws to ensure that your board allows for executive committees to make those decisions. We also listed some other best practices, and I won't go through each one, but they're there for your reference, but the critical understanding here is not to allow one person to dominate any meeting. A board is supposed to be made up of several people, as we discussed, and any of those decisions should really be documented in minutes, clearly and concisely. And finally, we mentioned the audit committee structure a little bit. As I mentioned, NYPR requires 3 independent board members to be on your audit committee. The audit committee can have other consultants and advisors, but as long as you meet that requirement, the audit committee structure should be met in accordance with the New York State law. So that being said, before we move on, we're going to stop and pause to see if there's any questions on that material.
Thank you, Kevin. This is John Olsen. You know, one of the things that was on the first slides, and I'll pause again for questions, is 2 things were on the first slide. We're giving you our email addresses at the beginning and end of this PowerPoint. If questions come up, George mentioned that you're going to have access to the materials. If questions come up in the next week or 2 and you want to email Kevin or I, please feel free to do that. And the other thing I just wanted to highlight, we're going through today what we consider best practices. The Nonprofit Revitalization Act includes laws that you're required to follow, but in my opinion, they don't satisfy the whole range of best practices. So what we're describing as best practices satisfy NYPRA, but they also include other things which we think may help your school and your board be healthy and have good board governance. And you may have questions about, you know, are they recommending something? You know, the 3 committee members, for example, as Kevin said, the audit committee has to be independent. It has to have a minimum of 3 people. That's part of the law. The conversation of a board of 12 to 18 size, that's really our judgment. The law doesn't specify that. But if you have questions on those issues, we're happy to answer that now or later. If there are no questions, we can go to the next slide. I'm going to cover the next 2 sessions. Kevin's session, the first session, was kind of an overview. This is a little bit meatier, these topics. There's a handful of slides in here that I'm going to go through quickly in the interest of time, but as Kevin pointed out, we hope some of these will be interesting to you. So if you look at what should our Audit and Finance Committee really cover, what's the range of services they should, of territory they should cover? And on this slide 15, it really kind of covers all of them: selecting and evaluating the audit firm, overseeing finances and internal controls, evaluate management's process for fraud risk and other risks, goals being to prevent, deter, and detect fraud. As Kevin mentioned, I'm a certified fraud examiner. I do fraud trainings. I have a lot of experience in fraud investigations. Promote corporate governance and appropriate ethical standards. Kevin covered some of the corporate governance things. And talk to the auditors. We're going to talk about that in the last section. So if you look at the next slide, as a certified fraud examiner, there's an international association called the Association of Certified Fraud Examiners, and that's ACFE. And every 2 years, they do a study of about 800 to 1,000 frauds, and they summarize various facts and figures and statistics. So some of the slides you're going to see here are part of this, the 2014 Global Fraud Study. The 2016 has not been released yet. Based on these surveys, they say that about the average organization loses 5% of its annual revenue to fraud. The median loss is about $145,000 per fraud, and 22% of the cases are in excess of $1 million. The next slide talks about, I think if you're going to ever want to do anything in your school about reducing fraud risk, one of the first steps I recommend is sitting down and having a frank discussion of what is your definition of fraud. And the simple examples are, someone takes some paper clips and paper home, you may not be concerned about that. But as you move up the scale, different organizations, I find, have pretty significantly different rules. A simple example, the school owns a vehicle, a pickup truck. The school might have relaxed rules and say, if you want to take that pickup truck home on the weekend and use it to move your son or daughter to college, that's okay with us. Other organizations have very strict rules and say that's fraud. So the definition of fraud can vary significantly from organization. Some of it's black and white. If someone steals $10,000 from your checkbook, that's pretty black and white. But other issues are a little softer. Workers' comp fraud, other types of fraud. I've seen the whole gamut. I've seen employees use the sales tax. If you are a 501c3 and you're exempt from sales tax, I've seen employees take the sales tax certificate and on the weekend buy a TV for themselves and use fraud. And clearly, management and the board can't focus on petty cash fraud. You have to be concerned about larger areas. Kevin, move to the next slide. There are various famous theories about fraud. The one I like the best is called the fraud triangle. And the theory goes like this. In order for a human being to commit fraud, three elements must be present. And the bottom right-hand side is pressure. The theory actually calls that unshareable need. One of your employees has something going on in their life that they don't want to talk about. It might be a variety of things. We'll see that in a minute on a slide. But there's something causing pressure on them. On the bottom left is opportunity. We're going to talk a little bit about internal controls. This employee who works for your school has pressure in their life, pressure on them. They don't know what to do. They're being painted into a corner, or they feel like they are. And they look around and they say, there's opportunity. Everyone here trusts me. When I have a check, I bring it to the CFO or the finance director. They never look at it. They just close their eyes and sign it. Whatever the opportunity is, I could sign a check. Nobody looks at bank reconciliations. Whatever the case may be, the employee sees opportunity. And the third ingredient up on top is rationalization. Most employees have to justify. A common one which does exist is, this is just a loan, I'm going to pay it back. So we're going to go through some slides very quickly, but we believe it's reasonable for the committee and certainly for the board to ask questions periodically. What do we do at our school to prevent or detect fraud? It is a success. If you detect fraud within a short period of time after it happens, that's a success. You cannot stop all fraud. You just want to catch it in a short period of time because the most devastating frauds are the ones that go on for years. So this slide lists some simple example. I've investigated frauds. I've put people in prison for frauds for every one of these items listed, and there's more. But the financial ones. And the other thing, you will never understand what goes on in someone's mind. It may seem trivial to you, but that doesn't matter. If it seems overbearing pressure to them, they may commit fraud. So all of the reasons on this slide, from financial to addictions, gambling, and others, and health issues, could cause someone to commit fraud at your school. The next, this study that I mentioned summarizes that fraud is a serious problem. It is vastly underreported. I happen to be a person, because of my training, when I see the local newspaper and I see fraud stories, I'm always interested in them. But I promise you, what you see in the paper is only a small percentage of what happens. Many, many employers do not want their name to be in the paper. They don't want, especially if you're a nonprofit organization. The classic is, well, if donors believe or parents believe that fraud committed at our school, they're not going to want to pay tuition, or they're not going to want to pay a tuition increase, or they're not going to want to donate. So for a variety of reasons, what you read in the paper is only a small percentage. E-commerce and the internet is a big factor. Go back just a second, Kevin. 58%, we're going to see that in a second. 58% of organizations that have fraud committed against them are unable to recover their losses. Go ahead, Kevin. I have a dry throat. The next three slides are graphics simply to show the most serious and devastating frauds are committed by there's three common elements. This one is age. The older people tend to commit larger dollar frauds. And the reason for that is they've been there longer, they have a higher degree of respect, they know where all the nooks and crannies, and they know where they can do something and no one will catch it. You can see people above the age of 50 or 55, much larger. The younger employees, when they steal, it's smaller dollars and they have less experience and less authority, they get caught pretty quickly. Kevin, then you can go to the next slide. Also, education is a factor. The people who have training and formal degrees are also in a position of authority commit larger frauds. And the third slide, excuse me, the third slide talks about position. The higher level in management or an executive, the more likely the person is to commit a serious fraud. So, of course, you're interested in all types of fraud, but the executives are the highest. And this slide shows in the blue, 58% of the time, no recovery whatsoever. and the little pie piece on the left, 11.7%. So 70% of the time, organizations that have fraud, employers, schools, nonprofits that have fraud committed against them, 70% of the time they get back less than 25 cents in a dollar for the frauds. A dry throat today. Sorry about that. What are the most common types of fraud? You probably can figure this out, but cash disbursements, cash receipts, billing, payroll. In a private school, payroll is probably not a huge factor. People can abuse overtime, and people can claim working when they're not working, and those are all serious, of course, but they're not. Yeah, you're good right here, Kevin. They're not likely to be devastating to the school financially. Depending on your school, you could have physical assets, certainly computer, technology, other types of inventory, things like that. The item I mentioned at the bottom is important. People believe that fraud only occurs in the business office, and that's really not true. Anyone in your school who has significant purchasing authority, that could be for a construction project, that could be IT. In a school environment, you could have a lot of IT in the classroom and the library and in IT centers. Anyone in your organization has significant amount of purchasing authority can find a way to commit fraud, never having to touch the checkbook at all, either through kickbacks or through creating false vendors. The next slide goes through, what. Oh, okay, Kevin, go to. I'm sorry, my fault. You're in the right. I'm in the wrong place. This slide is another, just a simple graphic, stepping back and saying this is a lot for the committee to do, but it really falls under this umbrella. You start at the top with good governance, a good board, a good executive, a good management. Technology is very important, and then looking at the financial reports that come to you as a board. That can be budgets, that can be monthly financial statements, that can be cash flow analysis, whatever they are. You need to have controls over transactions. You can see key controls over transaction cycles. You need to make sure that management makes reasonable estimates. A good example, usually schools don't have a big problem with uncollectible tuition, but that could be a key estimate. It could be a bequest or a donation. And you need to have good accounting policies. But if we look at the next page, and I recognize we are going through some of this quickly, but we're trying to whet your appetite, give you some food for thought. As I said, we would be happy to answer questions and or take email questions after today. What can you do as an audit committee or a board to look at things? One is you should be aware of segregation of duties. If you have a small business office, you should ask questions like, how do we make sure that all key transactions have two people? One person prepares, one person checks. What are the controls that we have in place? If your auditors hopefully are paying attention, they're giving you management letter comments, may also help highlight some of those areas. Looking for proper management oversight, looking for management override. Again, you can have the best policies in the world in writing, but if management ignores those policies and doesn't enforce them, they can cause problems for you. The next couple of slides, this slide talks about financial statements. So imagine sitting in a finance or audit committee meeting or possibly at a board meeting, you receive various financial reports. As a board member, as a member of management who may not be in the finance office, ask good questions. You see changes in revenue. Why is revenue up or down? Why are we not making budget? Certainly changes in operating margins or expenses, travel reimbursement, seminars, conferences. They're human beings. Unfortunately, it's common to see abuse in travel and expenses in all types of organizations. Unexplained changes in cash flow or unexplained changes in financial aid. There's a lot of nooks and crannies where problems can arise. From a good board governance standpoint, the most important thing is that you have a committee and you have board members who look at the materials and ask questions and very nicely insist on good answers. Don't take simple answers. Oh, I'll check that and get back to you next month, and then no one follows up. You can, if you're getting good financial reports, you can help spot some of these things. And if an employee believes that someone is watching, and if an employee believes that someone is asking questions, that is a major deterrent to an employee playing games. So that's one of the key things that you can do. And we're happy that many of our nonprofit clients have good board members who ask good questions, who are inquisitive. And to Kevin's point earlier, if your board is filled entirely with people who are teachers or college professors or nurses, they may not have the skills to ask some of those questions, where a banker or an accountant or someone with an entrepreneur in the community who runs their own business may be better able to ask some of those questions. So that goes back to the diversity of the board. The next slide, the next two slides, in the interest of time, I'm just going to mention to you that we put in here a something more simplistic, what we call a fraud prevention checklist, something that you could use to start a dialogue. Is ongoing anti-fraud training provided. I'm not going to go through each one of these steps. It may sound like a simple analogy, but we all know, being involved in a school, or you may know as a parent, if you don't talk to your kids about drugs, they won't understand drugs. If you don't talk to your kids about what's ethical and what's legal, they won't know. And the same thing applies to your employees. You should talk to your employees about fraud and honesty and integrity is very important to our school. If you see or hear anything that you believe is not honest or being conducted with integrity, please tell us. And that's a simple start. It's a low-cost start. So this slide and the next slide gives you some examples of things that you could do to reduce the fraud risk inside your organization. And fraud risk and internal controls go hand in hand, because you may raise a question about why is some number up, some revenue down, or some expense up. It could be fraud. It could be that somebody made an accounting mistake and that your internal controls didn't catch it. So these kinds of questions, heightening the awareness that there's healthy checks and balances and healthy board governance in your school, reduces the risk of fraud, but it also increases the chance that your internal controls will be strong from simple errors or mistakes. Looking at the clock, my notes say that I'm supposed to move on to a next session. I know I went through some materials kind of quickly. I will pause if there's any questions.
And just a reminder, if anyone has a question they'd like to ask John or ask Kevin, all you need to do is unmute your microphone, which you can do by clicking on the lower left-hand corner of your screen or clicking on your own image and unmuting.
Thank you, George. All right, well, again, in the interest of time, we will move forward, but we don't mind questions at any time. You can interrupt me in mid-sentence if that helps you. The third section out of 4, Kevin mentioned, most of we're gonna give you an overview of the Nonprofit Revitalization Act, but focus on 2 things. There were some amendments in December 2015. Most of them were pretty minor, nitpicking kind of clarification things. But there's also a couple of things in these slides that we think board members sometimes miss, or nonprofit organizations sometimes miss. So this slide is a good snapshot of the major components of the Nonprofit Revitalization Act. The law went into effect in July 2014. It was a major change in New York State. It was the first real attempt to have mandated board governance and internal controls. I think it was a step in the right direction. The Deputy Attorney General, Jim Sheehan, for the Charities Bureau in New York State, I've heard him speak a number of times. He was in Albany last week or 2 weeks ago, and I heard him. The Attorney General sometimes can be pretty harsh. They have been fairly relaxed with this. They published a law. The law has been in effect 18 plus months, 20 months. They continue to say, we want you to try to be in compliance. If you're not in full compliance yet, that's okay, but at this moment, after 18 months, 20 months, you should have a written plan to be in compliance. Hopefully, most of you are well on your way or in compliance. So the key elements: conflict of interest, whistleblower, board independence, the audit process we're going to talk about as the last part of this, related party transactions, board communication we've talked about already a little bit today. This last bullet on personal responsibility, you know, it's a threat. I've been doing this for more than 30 years with nonprofit organizations. The law specifically says if the board is negligent, and probably significantly negligent, and harm comes to your nonprofit organization, there is a chance that the Attorney General can go after board members individually. It's pretty rare. I don't think you should worry about it. If you're in a board that's negligent, you should fix it or resign from the board. But that is part of the law. So let's talk a little bit on the next slide about some of the things that are more common, and we've, in our experience, our clients, our nonprofit clients, are still struggling with a little bit. The first bullet, we all know that board members should complete a form about conflict of interest. This law did something different, and it said prior to electing a board, if I was a prospective board member at your school, you should have me fill out a conflict of interest form before you bring me to the board. That should be given to the board, and before the board elects me to your school board, to your board of trustees or board of directors, you should have seen my conflict of interest form. I found a lot of our nonprofit clients were doing the annual conflict of interest forms, but they were doing it after the board member was elected. The other thing, you know, that policy should talk about the conflict and what the procedures are for disclosing it, and specifically say that if you have a conflict of interest, that you can't be present when there are deliberations on your subject matter. In the next slide, we'll see a couple of examples of that, Kevin. Oh, it's a following slide, but that's okay. Again, the policy must include the documentation for detailing the existence, so that's pretty much filling out the form and resolution of the conflict, and procedures for disclosing, addressing, and documenting the parties. The second bullet, we'll give some examples in just a minute. The second bullet on this slide I think is important. I've had a number of clients send me their conflict policy and say, would you look it over and give me your thoughts? And what I find is the policy is directed to the trustees or the board members, and it's not, doesn't cover key employees. You definitely, the policy would also apply to key employees. I think we'll see that coming up on a slide. Go ahead, Kevin. What are some common conflict issues? Health insurance, for example. If in your part of New York State, if there's a local HMO or a big insurance company, and you buy health insurance from that HMO, and you have a board member that works from that HMO, if you pay that HMO more than $25,000 a year, that board member is not independent. Now, there's no harm in that board member being on your board. You can have that person on your board. They can't be on your audit committee because they're not independent. And what it means is once a year, if you decide to stay with that insurance company, and let's say you spend, you know, health insurance is expensive, you spend $100,000 a year with that insurance company. When that comes up, maybe budget time or once a year, you should remind all the board members that, gee, John Olsen's on our board and John works for this big insurance company. So we're going to renew our insurance contract. So we're going to ask John to step out in the hall, and the board will deliberate and make a decision to renew that contract with John being outside of the room. And the same would apply, obviously, in any cases. That could be a lawyer that you also pay as a lawyer, someone in IT services, construction, investment banking, etc. Those are some of the examples. And the key part here is that this could be a board member, or this could be, if your head of school is their spouse is a key person, a vice president in this insurance company, the same thing would apply for your key person. So the next slide, I believe, covers definitions of key employees. The IRS has definitions of key employees for Form 990, and NIPRA has definitions. The definitions are intended to be a little bit vague. I mean, clearly, if you look at a school, it'd be hard to argue that the head of school was not a key person. And whatever title you use, CFO, controller, director of finance, that person would also be a key person. But you could have other people on your management team who also have clear, heavy influence, purchasing authority, spending authority, or managerial responsibilities. So your policy should clearly cover the full board and at least your head of school and your CFO, director of finance, and it could include other people as well. And then make sure that any of those conflicts are disclosed. Both the IRS and the Nonprofit Revitalization Act, there's absolutely nothing wrong with having board members who do business with the school or have worked for companies that do business with the school. The challenge is to make sure that everybody else on the board recognizes that there's a conflict of interest and that that person is not in the room. If I worked for that insurance company and I'm in the room, there may be board members who don't want to offend me, so they're just going to vote yes, even though they don't think it's a good idea to buy insurance for my company. If I step out in the hall, those things can be said in a more open air, and if they're said, at least I wouldn't know who said them. So it's a much healthier process. Kevin, you can go ahead. Executive compensation is another key area. The IRS has rules on that. Certainly part of good board governance is to make sure that what your key person, usually this is limited to the head of school. There could be cases where the board wants to know what one or two other key employees are involved, but certainly the head of school works for the board, and the board should have policies in place to make sure that the compensation is reasonable and it should be documented. One second, I'm just looking ahead here. 1 second, okay. This item that's labeled new, there's really two issues here under executive compensation. In my experience, it's relatively rare. The nonprofit organization can pay board members. So let's say a school, usually what happened in a very large school, they might say, we're going to pay a stipend. If you come to our board meetings, we're going to pay you, just a token, $500 a meeting or $200 a meeting or whatever. One of the clarifications in December 15 is that if you have that situation, the entire board can vote on it collectively. You don't have to go through any silly rules where people step in and out of the room to vote on their own compensation. The one that's more likely to have an impact is the school head of school compensation. And Kevin, if you look at the next, Kevin, take us to the next slide. Thank you. So let's focus on the one that applies to everybody. Most of our nonprofit schools or nonprofit organizations do not pay their board members. Their board members volunteer. But for the head of school, the best board governance, the best practice to have is, one, you should have a job description for that person. That person should have annual goals. There should be an annual evaluation, a committee of a few folks who sit down with your head of school once a year and say, how did you do? Did you perform according to your job description? Did you satisfy your goals? If not, why? A board compensation committee can be the same group. That committee should look at a salary survey of peers. They should try to make sure that the salary level that you are paying, if you are assuming you're a nonprofit organization, the salary level that you are paying should be comparable to peers or defendable within a reasonable range. If your head of school is outside the range, there should be documentation in your files that your head of school is doing such an extraordinary job that he or she deserves the extra compensation. And then the committee can make a recommendation to the board. These are not requirements per se, but these are all come from IRS rules and other New York State rules that give indicators of what would be good board governance. And so I think it's easier, more manageable to have a committee, a small group of people do this, and then make a report back to the full board. But the ultimate goal is, it's simple. I've interviewed board members occasionally, and they said, well, I don't know how much our executive makes. The board should know how much they make, and they should have a general idea of why that person is being paid. Either they're at the high end of the range or the low end of the range of their peers. So, and of course, all of that should be documented. Kevin, the next slide. A few other December 15th deadlines, and I'm watching my clock. Kevin's going to do the last session here, so I'm going to go through these quickly. There were some questions raised when the nonprofits were struggling with quorum. The New York State laws, most board governance rules say the board can't act unless you have a quorum. So some organizations had bylaws with funny rules about how big their board was, and these rules actually make it easier. Generally, if you have 12 people on your board and you have 7 at a meeting, you have a quorum. So it doesn't matter if you have vacancies or not. So you're pretty much covered there, but there was some confusion there. There was also some confusion, and these may not apply to this group today, so I'm trying to go through these quickly. If your school had a separate foundation and the school controlled the foundation, or the foundation controlled the school through sole corporate member, there was direct control, then when you look at conflict of interest and other things, you have to look at both companies. If you happen to have, let's say you were a primary school, but there was a preschool down the street that you had some common board members and you were kind of loosely affiliated, but you did not control that preschool down the street, then you do not have to go through the conflict of interest and all those other rules with that organization that is not tightly controlled. There's a obscure requirement that if you have board members who used to work for your CPA firm, those board members are not independent. And the last bullet, I did have this question come up at an NYSAIS conference last summer, a regional meeting. a board member, someone said to me, well, how can I be independent? My daughter goes to this school and I pay tuition. And my answer was, that doesn't matter. And this law agrees with what I estimated or guesstimated last year. If you write a check to the school, that doesn't taint your independence. I mean, the only exception to that would be, because most schools are loaded with parents and most parents are paying tuition. If you had a policy, which I've never seen, well, our tuition is $15,000 a year, but if you're a board member, you get $2,000 off. That might taint your independence. But presuming that your trustees are paying the same tuition as every other parent and there's no preferential treatment, then you can write a check to the school and still be independent. And that would apply with donations and contributions as well. It's only what taints independence is when the school is paying you, not when you are paying the school. But there was a lot of confusion about that, so they fixed that in the December meeting. Kevin, the next slide. The other rule, and it's interesting, I've talked about if there was a conflict of interest involving me and I'm on your board, I'm supposed to step out of the room. Well, that's great, but what if you have a board member of 12, a board of 12, it's a snowstorm, so you only have 7 people show up and you're happy to have a quorum, and then you ask John Olsen to step out in the hallway. Do you still have a quorum with John Olsen in the hallway? And the Attorney General says, yes, you still have a quorum, even though, so I guess my vote would be a no vote, abstaining from voting because I'm in the hallway when you vote, but it doesn't ruin your quorum. I think the second one I covered, if trustees are being paid, that was in here twice. Whistleblower policies. The Nonprofit Revitalization Act says that whistleblower policies need to be distributed to employees, to board members, to students in your case possibly, to vendors. And there was a lot of confusion about how do we satisfy that law. So the AG kind of relaxed it a little bit and said if you post it to your website, or you have a link to your website, or if you post it in some conspicuous location, you don't have to physically print it or email it or hand it out to everyone that may be interested in your whistleblower policy. So in summary, with I might be 1 minute behind, the Revitalization Act has been around for a couple of years. In my judgment and everything I've heard, if you are not in full compliance today, probably no harm will come to you, but I do believe you should try to identify where you're not in compliance and try to button that up as quickly as you can. And my last piece of advice, it's not here in the slide, is board minutes are critical. The NYPRA does not require that you put anything in your minutes, but my experience and Kevin's experience with state regulators and the government is if they come in to audit you, they're going to look at what happened 3 years ago. And if you don't have it documented in your minutes to say this is what happened, then it's all going to be based on hearsay. And if you were unlucky enough to have turnover on your board or turnover in your management, then people are going to say, I don't know. So I strongly recommend, and have your minutes indicate, the simple example I gave is the health insurance. We want to renew our contract with ABC Health Insurance Company. John Olsen is on our board. Our annual, we expect to spend $100,000 with that insurance company. We've asked, John Olsen stepped out in the hall. The board deliberated. The board voted to continue that $100,000 contract. John Olsen came back into the room. And try to cover through your minutes or board resolution, try to make sure that you have all good documentation in there so that to me, it's the easiest way that if the Attorney General ever knocks on your door and says, we'd like to see if you're in compliance, you're going to have a clear documentation trail. I'm going to ask Kevin to go ahead unless someone, but if anyone has questions, just please jump in and interrupt us because I know that we scheduled to be done at 5 o'clock and we want to, we don't want to hold up anybody. Kevin, do you want to go ahead?
All right. Thanks, John. Yeah, I'll move ahead. And we will be done at 5, but John and I can hang around after 5 o'clock if anyone wants to stay on as well. The last piece here is another significant item of what NYPRA covers. We mentioned it as one of the bullet points of the Finance and Audit Committee's considerations. And what I want to talk about now is their interaction with CPAs or your audit firm. John and I both deal a lot with audit committees, both at the beginning and end of the audits that we perform now, mostly because NYPRA is requiring it, but secondly, it's a very important aspect of what you're getting out of your audit. So to keep in mind in all of this is that we, the CPAs, work for the audit committee. Although it's great to have a great relationship with management and your head of school, we're ultimately responsible for reporting back to the audit committee, which is why it's important to understand what communications are supposed to be done throughout the year. So we'll talk a little bit about selecting and evaluating your audit firm, meeting the requirements under NYPRA, and we'll give you a few questions to ask that you can take for your consideration when communicating with your auditor. So the first slide is your auditor really the right audit firm to be doing your audit? You want to consider several different things. Do they have expertise in your industry and not-for-profit expertise specifically? Are they determining and creating appropriate audit approaches and steps to complete your audit? I'll give you a few questions to ask about that. Is the communication to the board clear, both at the beginning and at the end? Are the results of the audit understandable? Sometimes CPAs like to talk in CPA language. And be sure that you're understanding what they're saying. Does your CPA have a recent peer review? Every 3 years, CPA firms are required to get a peer review done from another CPA firm. Is there any findings associated with that peer review? Is your CPA firm providing any independent advisory services where they're making management decisions? It's important to be sure that your auditor is independent from the audit work that they are doing. Are the final presentations timely and clear? Are they meeting your deadlines for issuing an opinion on your financial statements? And what other value-added observations are they giving? Sometimes CPA firms give some IT-related comments or some NYPRA compliance issues. Sometimes those are at no cost, sometimes those are at moderate fees. So those are all important things to think about when selecting and evaluating if your audit firm is the right firm for you. And as we mentioned many times before, it's important to document that in your minutes as part of the NYPRA compliance. NYPRA also requires the audit committee to meet with the auditor, not just at the end of the audit, but at the beginning of the audit as well, really to understand the scope of what the auditor is going to do. What areas are they going to concentrate most of their time in? What risks have they determined that would affect their audit? Understand who's responsible for what. In that, there's 3 players: you, the audit committee, management, and the auditor. There's a lot of different responsibilities for each one of those players, but really, who is responsible for those financial statements? That's management. It's the auditor's responsibility to issue an opinion on those financial statements. Understand the timing. When will the audit start? When will the audit conclude? When is the auditor expected to communicate back to the audit committee? Understanding the results of the audit is key. Were there any audit differences? Were there any internal control deficiencies that the auditor found? That's all important when determining the risks of fraud and financial reporting that John mentioned before. It's important, if there was management letter comments from prior years, were those fixed? Those are questions that you would want to ask your auditor, because you wouldn't want any lingering problems in internal controls that haven't been addressed.
Yeah, this is John. I would just add, I have heard the Deputy Attorney General, Jim Sheehan, make comments at webinars and presentations that he's convinced audit committees are not doing a good job because the auditors deliver a management letter and it just gets filed away and nobody ever follows up to see if they're, a whole year goes by or more and no one follows up.
Mm-hmm. Great point. If the auditor comes up with any audit differences that's often communicated in a required communications letter, What does that mean about the financial data that you've been looking at throughout the year? Does that mean that the financial reports that you've seen were inaccurate until the auditor came in and made an adjustment? So understand what accounts that they have hit, how significant were they. It's also important to meet with the auditor without management in the room and to document this executive session in the minutes. The Attorney General is convinced that management can be leading the audit committee in one way or the other. So it's important to separate them. You could do it at the beginning and end of the audit, just to ensure, as I mentioned, the auditor is really working for the audit committee. So it's important to understand if there's any fraud risks and communicate that with the auditor without management in the room. And finally, we understand that a lot of people may not be financially savvy people on your board, but it's important to understand at least the basics of the financial statement. So ask your CPA if they could give you a brief training or understanding of those financial statements, so they actually mean something when the auditor comes in and reviews those statements with you, and when management reviews the statements with you throughout the year. The next few slides, actually just this last slide, is a list of different questions. There's a whole other sample of questions, but these are some key questions to consider asking your auditor at the end of the audit. I won't go through each bullet in the nature of time, but they are there for your reference if you want to go back and use them when it's audit time for your school.